You've seen the headlines, right? Billions, and I mean billions, of dollars are flooding into these new Bitcoin ETFs. It seems like the perfect rocket fuel for a price surge. But then you look at the chart, and it's just flat, kind of stuck. So what is going on? Well, today we're going to solve the great Bitcoin ETF paradox.
Okay, let's just start with this number, $2.1 billion. To put that into perspective, that's more than the entire economy of some countries. It's just a truly staggering amount of money.
And look, that $2.1 billion wasn't some slow trickle over a year. No, this was a tidal wave of cash. It all poured into the new spot Bitcoin ETFs in just 9 trading days back in April. The demand, by pretty much any measure you can look at, has been absolutely historic.
Which, of course, leads us to the one big obvious question we're all asking. With literally billions of dollars in new demand, why isn't the price of Bitcoin shooting to the moon? What gives?
This right here is the billion-dollar mystery. The data, incredibly bullish. I mean, we're talking over $100 billion in total assets just sitting in these new ETFs. And yet, the price of Bitcoin keeps hitting this wall, just struggling to punch through that $78,000 mark. It kind of feels like we're flooring the accelerator, but the parking brake is still on. So what's really going on under the hood?
To solve this thing, we've got to look for clues. And our very first one, it's hidden inside the mechanics of how these ETFs actually work. Believe me, it's not as simple as just clicking buy.
Okay, so the key players you need to know about are called authorized participants, or APs for short. Think of these as the big financial institutions, the machinery that actually creates new ETF shares when investors want to buy in. And how they do this? Well, it reveals our first clue. There's a really crucial delay in the whole process.
So here's how it works in a nutshell. Step 1, you buy shares of the ETF. Step 2, the AP goes and creates those new shares to meet your demand. But here's the really important part. Step 3, the AP doesn't instantly buy the Bitcoin. They might wait hours, or maybe even until the next business day to actually get the coins needed to back the shares you just bought.
So what this means is that headline-grabbing inflow number you see today doesn't immediately translate into buying pressure on the market. This time lag creates a little window, a gap, where other market forces can come in and counteract that new demand, kind of muting its immediate impact on the price.
So, okay, we've got a time lag. That's clue number 1. But that's only part of the story, right? Because for every $1 billion of buying, there has to be $1 billion of selling. That demand is being met by someone. So the question is, who is on the other side of this massive trade, and why on earth are they selling?
It's like a tale of two cities. On one side, you have the new buyers. This is institutional money coming in through these slick, regulated ETFs, and they're looking for long-term exposure. But on the other side, you've got this really formidable group of sellers, existing short-term holders, and these large whales who are looking at this new wave of demand as the absolute perfect opportunity to offload their coins. And this quote from Glassnode really explains why they're selling. It says the $80,100 level is the cost basis for short-term holders. So what does that actually mean? Well, in simple terms, it's the average price that all the recent buyers paid for their Bitcoin. So for them, this price isn't a launch pad for new highs. It's a chance to get their money back to exit the market at break-even. It's a huge psychological wall of supply.
And you know what? The on-chain data totally backs this up. We're seeing a huge spike in coins moving onto exchanges. We're talking 11,000 Bitcoin per hour at times. That is a classic sign that people are getting ready to sell. And at the same time, the volume of large transfers is up over 40%, which tells us that the big players, the whales, are actively selling their holdings into all this new institutional demand.
Okay, so we've got a time lag, we've got a wall of sellers, but there is a third, really powerful force at play here. And for this clue, we need to zoom out a little, away from the crypto market and into the bigger world of global finance.
Negative 0.90. Now, this number might not look like much, but right now it is one of the single most powerful forces pushing down on the price of Bitcoin. What it represents is the 30-day correlation between Bitcoin and the US dollar index.
Now, for anyone who's not familiar, the DXY is basically just a way to measure the strength of the US dollar against a whole basket of other major world currencies. So when the DXY goes up, it just means the dollar is getting stronger on the global stage. Simple as that.
Now, a correlation of negative 0.90, that is almost perfectly inverse. It means that as the dollar gets stronger, it acts like a gravitational pull on Bitcoin's price. Think of it this way. A strong dollar usually means there's just less cash sloshing around the global economy. That makes investors a lot more cautious and way less likely to buy riskier assets like Bitcoin. So while the ETFs are trying to push the price up, the strong dollar is actively pulling it down.
All right, so let's put our clues together. We've got a time lag in the ETF buying, we've got a massive wall of sellers who are trying to get out at break-even, and we have these powerful headwinds from a strong US dollar. All of this, together, allows us to finally solve the mystery of the missing price boom.
What we are watching happen in real time is not a failed rally. It's actually a market phenomenon that has a perfect name in Korean, sunbakwim. This one phrase is the key to understanding this entire situation. Sunbakwim pretty much translates to a turnover or a changing of hands. We are in the middle of a massive reallocation of Bitcoin. Ownership is systematically shifting from one type of person in the market to a completely different one.
And this slide just shows you the whole process in action. First, new institutional demand arrives through the ETFs. That's the catalyst. But instead of an immediate price explosion, that demand is being perfectly met by supply from all those existing holders. And the result is this huge, gradual transfer of Bitcoin from so-called weaker hands, think short-term traders, over to stronger hands, which in this case is that long-term institutional capital.
So why does any of this matter? Well, it means that just under the surface of this choppy, boring price action, the market is actually building a much healthier, more stable foundation for the future. But it also means the price is probably going to stay sideways until this great turnover is complete. It's just a powerful reminder that those big, flashy headline inflow numbers, they're never the whole story. This is what a maturing market looks like.
So the paradox is solved. The billions are flowing in, but they're being used to facilitate a historic change of ownership. And this leads us to the real question we should be asking ourselves. With this new, strong base of institutional owners soaking up all the supply, what do you think happens to the price when there's finally no one left to sell?